Ladies and gentlemen, welcome to Bloodbath Monday. An absolutely crazy day. The NASDAQ 100 was down 3.8% today. We're going to talk about why. We're going to talk about all the reasons why stocks are falling, why the selling continues, and when does it stop. We're going to look at the value rotation and what it means for you as an investor, and maybe places where you should put your money as a whole. We're going to talk about market corrections, recoveries, and we're going to look at potential key levels for you to get involved to go ahead and make money. We're going to answer the question, is this a buy or should you get out of equities completely? We're also going to look at the history of recessions as well as Oracle's earnings. Did they miss or did they beat, and what fair value is? But guys, before we continue, if you could please go ahead and subscribe, hit that like button as well. It's imperative for small channels like this one. We only have 357 subscribers. It's imperative for you to subscribe small channels to help them grow. That is absolutely key. Now, you guys know I don't ask you for anything. I don't have a course to sell you. I don't have software to sell you. I don't have an email list. I would never run an ad on any of my shows. All I ask is for you guys to subscribe, like this video, maybe follow me on Twitter, and go ahead and hug your mother. Now, let's talk about the market as a whole. Now, the NASDAQ 100 was down 3.81%. Very, very scary. This type of, I would guess you could call it bearish capitulation where, you have a massive gap down and you just make lower highs, lower lows into the end of the day. Very, very scary for investors, especially those investors that only have started getting involved in the markets around 2022 when the lows was put in. This could very well be your first major sell-off. And if you're a retail investor, you're invested in stuff like Nvidia, Robinhood, and Tesla, this drawdown is particularly painful. Robinhood just 3 weeks ago was $70 or very close to $70. It's now halved in value. Tesla is down about 48% from its highs. Both these stocks were down in excess of 15% today. Crazy, crazy price action. It's a very thin market, not a lot of buyers. Nvidia down 5% and here at the $100 mark, looking very, very attractive if you ask me. Look at what has actually led today. The Coca-Cola company, this is a staple company, some would consider a defensive stock, outperforming these growth leaders lately. AT&T, a telecom services stock, also outperforming, up 0.59% today. Now, the reason why you're seeing these stocks outperform is because Coca-Cola is considered a defensive company. Same with AT&T. At the end of the day, almost everybody almost every single citizen in a Western country has an iPhone. Okay, they have an Android. They need to pay their phone bill because they need 5G on the go. They need to be able to call their mother, to call their daughter. And they're likely paying their daughter's phone bill as well, especially if she's under the age of 16 or 15. They're probably paying that phone bill. You look at a company like PG, I don't think your boss is going to be very happy at you if you come to work with your breath smelling. So you're going to have to go out and buy toothpaste, okay? That way you have these. So those are considered defensive stocks because there's certain things people need to spend money on. That is why we're seeing that outperformance. And generally speaking, when you see these defensive stocks outperform, it really does signal. It is a market signal for incoming turmoil. Now, year to date, we have actually seen, that value rotation. It's normally what we call it. We've seen value as a whole outperform year to date. These stocks right here have performed year to date, but they were the laggards in 2024. Look what performed well in 2024. Large cap stocks, growth stocks, technology stocks. In fact, tech was up nearly 35% last year. So last year's leaders have become this year's laggards, and last year's laggards have become this year's leaders. Now, we actually did have something similar like this happen in July and August last year, which you did see these value names outperform, but it lasted only 6 or so weeks. So it's yet to be determined if this is going to continue or if tech stocks, growth stocks will regain leadership into the back half of 2025. Time will tell everything. But what we can say for certain right now is that these value stocks are genuinely looking cheap. Even large cap value trading 2.5% under fair value. This is according to Morningstar, with large cap core and large cap growth actually trading well above fair value, with large cap growth 13% above Morningstar's estimate of fair value. But we also see, stuff like mid cap, stuff like small caps, again, particularly value and core, quite undervalued relative to their growth counterparts as a whole. And growth in every single size segment, large, medium, and small, looking rather overvalued. So this rotation we're seeing from growth into value, we're doing it because US markets as a whole look expensive, but not everything. And if you do look under the hood, value stocks are definitely catching a bid. However, the recent pullback we've seen in the S&P 500 has been about 9% from peak to trough as of today. And that would mean that the S&P 500 or the US market is actually undervalued right now. We went from about 7% overvalued in just 3 weeks to 4% undervalued. And I think this is where you start getting in, because we very rarely pull below these points right here. 3 to 4% is sort of the lows that we do get to, and then we actually see dip buyers come in. So for those of you that prefer ETFs over single stocks, this is the place where you start deploying capital. And at the end of the day, guys, market corrections are gifts. Market corrections are simply gifts for you to make outsized returns in the years and even decades ahead. Had you bought the 2008 dip, you'd be thanking yourself. In the S&P 500, you'd be up 500% since 2008. Now, the S&P 500 total returns, this is since World War II, guys. Market corrections peak to trough generally fall about 14.1%. That is the average market pullback, the average market correction, right? And generally speaking, within about 200 days is when we see the relative market bottom. So we sort of like decline right here. You can see anywhere from 150 to 200 days. That would be about 6 to 9 months. And then the average recovery takes about 4 months. And that is why tops tend to be these long drawn out processes, as you can see right there. And then bottoms tend to be like events. We tend to put in bottoms very, very quickly, and then the market continues to rally to the upside. And that is why I say generally at every 5% interval, you actually want to buy the dip, because 5%, deploy some capital. At negative 10% where we are right now in the S&P 500, you want to deploy some capital. And then at about 15%, you want to deploy some capital. And if you actually look at the average market correction, which is 14.1%, generally speaking, you actually won't get there. You'll only get only 2 opportunities. This is just the average of all market corrections. They can be shorter, they can be longer. But as long as you have a system to take advantage of opportunities like these, you will be successful in the long term. And yeah, this is the system I follow. You should use it as well. It's a great system. 5, 10, 15% pullback. This applies to indices and stocks as a whole. But in the here and now, what is a good place to buy the S&P 500 dip? And right now, there is high volume, historic volume right here between the 5,400 and 5,500 area in the S&P 500. So this is the place where you want to buy the dip. We're about 3% away from hitting the middle of this range. So, if we do have a couple of really ugly red days, that's when I would really start getting active. And that would actually represent anywhere from about an 11 to 12% pullback in the S&P 500. So this is a great place to buy the 54 to 5,500 area. Now, what have I been doing in my portfolio? Now, I actually post a weekly portfolio update on X. What I've done is I sold a bit of Meta, I sold a bit of Visa, right? I actually bought some APA. This is a defensive utility. Now, this was at the start of last week. So I rotated some cash into a defensive utility sector. Again, you have to pay a power bill. That is a defensive sector. So the defensive sectors, for those of you that don't know, is utilities, ticker symbol XLU in the US, XLP, this is consumer staples, and then XLV, healthcare. There are a couple of other defensive sectors that can be cyclical but can also be defensive. One of them is real estate. The ticker symbol is XLRE. That's the real estate sector. But again, there's a lot of other components that do depend on it. And then you also do have stuff like XLC, especially telecoms. They trade in the communications space. Telecoms tend to be very, very defensive. There's also some other names in financials, stuff like insurance names, because they have just large cash balances and they can weather any type of storm. So there's various types of defensive sectors and subsectors in the market. It's not just your typical utilities, staples, and healthcare. There's various other components of each sector that can be considered very defensive. For example, in the tech space, many people consider Apple a defensive stock just because of its wide moat, how it derives its revenue, the amount of buybacks it does, its dividend. Many people consider Apple a staple technology stock of sorts. But I digress. when I bought, I sold a little bit of Meta, a little bit of Visa, rotated into APA, again, a utility stock. And I've also been buying a little bit of Evo and a little bit of PayPal. That's all I've done in the last couple of weeks. For the most part, all I've really done is just built up my capital. I've been, just building up cash and deploying into my ETFs. Every single week I buy a little bit of each ETF, just quality growth ETF, regardless of what the market does. So I have my single stock portfolio, I have my ETF portfolio. That's really all I've done. But guys, look, you want to take opportunities. You want to know something crazy. This is absolutely insane. Since 1928, 97 years, the S&P 500 has only been down more than 10% on the year 12 times on a total return basis. Only 12 times. In other words, the majority of the time, when we do get a 10% dip, you want to buy that dip because we will actually make gains on that past some of those losses on the year. Now, of these 12 times, 8 were due to recessions: 1930, 31, 37, 57, 73, 74, 01, and 08, right? 3 were due to World War II, right? So here, 1940, 1941, we had 2 years where we saw negative, where we saw the S&P 500 have declines greater than 10% in each year. That would have been an ugly 2 years for the S&P 500. And then major geopolitical tension in 2002, World Trade Center, the Afghan War, etc. Okay. And then 1 was due to a Fed rate shock that didn't cause a recession, but stocks did pull back in a material way. And that was very recent, 2022, the most recent major bear market we had in the US market. So look, the key takeaway here, guys, is that it takes a genuine big shock to kill a market, right? It takes a world war. It takes a recession. It takes a policy misstep. Now, one might argue we're taking a policy misstep here with tariffs, maybe the Fed cutting too early, maybe the Fed's behind the curve, but that's all speculation. We'll have to see how this pans out throughout the year. Either way, stocks looking robust, earnings are set to grow, and the economy for the most part, especially up to the data we have right now, is looking really good. And I think this is still an opportunity to get long. We're down about 10% in the S&P 500, about 13% in the NASDAQ 100. I think you want to start deploying capital in a very big, but you definitely want to start getting excited and you want to start buying the dip at these levels. Now let's look at a company that reported earnings today that may be a buying opportunity, Oracle Corporation. Now, Oracle was down 4% today, and that's because the broader tech sector did fall. Down 3.29% in the after hours. Very volatile here upon the earnings release, but after the earnings call, we just saw the stock absolutely dump and are falling peak to trough 5% in the after hours. At one point, Oracle was actually positive, so we did see a 4% move to the upside about there, but then we saw all of those gains paired towards the end of the after hours trading session. And Oracle's earnings were actually not that great, if you ask me. I don't know why we had that initial bounce up, that 4% move, but Oracle actually had a double miss. They missed EPS expectations of $1.49. They missed revenue expectations by $260 million. That's a pretty big miss. However, they still grew year over year in both segments. So the expectations coming into this earnings was simply too high for Oracle. And then looking at guidance, because the street doesn't really care about this. You can report terrible earnings and actually have great guidance, and the street will reward you. Now guidance actually missed again. The street was expecting $1.75. Management came out and said we're going to do $1.61 to $1.65. And then total revenue growth forecasted at 8 to 10%. The street was looking for 11%. It was a double miss, lowered guidance relative to the street's expectation. Although we're still looking at growth on a year-over-year basis, so there's nothing wrong with the actual business model of Oracle. And there were certain segments, their cloud and AI segments, that was growing at like 49% year-over-year. So, they definitely do have some high growth components of their business growing and, benefiting from AI. And the company also said that they will spend around $16 billion in capital expenditures, which is a little more than double the total from last year. So they spent $8 billion pretty much last year. They're planning on spending $16 billion. That bodes very well for NVIDIA, SMCI, AVGO, ASML, all of these semiconductor stocks. It bodes very well for them, the infrastructure names, the utility names. So with regards to hyperscaler CapEx, Oracle being one of the hyperscalers, I guess, look, we're seeing a huge jump up in CapEx. There's definitely demand for AI. And I think that a beneficiary of this is going to be Nvidia. Now, is Oracle a buy? According to Morningstar, it is. I do think that fair value is going to get lowered, but I don't think it's going to be materially. I think you should see fair value at about 168, depending. But anyway, the closing price was 148. After hours, you're looking at about 143, 142. That is a pretty big margin of safety. Again, based on Morningstar's data, it's trading at a 3-star stock. Could actually be potentially 4 stars here in the after hours, which is very, very attractive for a very wide mode business like Oracle. Great wide mode business, one of a very few competitors that actually have the scale to compete with something like Microsoft, Google, Amazon, etc. So is Oracle a buy? According to Morningstar, yes, it is. But again, you'd have to go over those earnings in granular fashion. Guys, but thank you so much. If you've made it up until here, thank you so much for watching. I appreciate you guys. I appreciate you staying this long. If you like this video, please subscribe and hit that notification bell. And also hit that like button and leave a comment for the algorithm. Cheers.